Hi everybody, and welcome to today's Facebook Live. We are here at Beacon Wealth Management with Beacon CEO Mark Germain, and today we're going to be talking about charitable giving. The reason why we're going to be talking about charitable giving is because Mark is going to explain to us some of the differences of charitable giving under the new Tax Cut and Jobs Act. So we're really happy to be speaking with him. Before we do, as you know, I just got a few disclosure items. Today is Wednesday, February 21st, 2018, and the time is 11 a.m. Eastern Standard Time. This Facebook Live is being recorded, so please remember that this is not giving an opinion, it's only giving blanket advice. Numbers are historic, and you must put your personal situation into perspective and meet with an investment professional, somebody that understands you personally and knows your goals. So thank you. So with that, let's get right into today's Facebook Live program. Mark, why don't you explain to us what is charitable giving?
Yes, thanks, Tina. I think that everyone kind of knows what charitable giving is, that you're giving money away. And I think what we did is we actually put it out there that it's an act, that you actually make this a conscious effort to give away money, usually to some type of entity, 501c3, which means they are tax advantaged and you get the maximum deduction for that. I think what's really important is people need to be charity-minded before this becomes a strategy that they're going to consider.
And so giving items of value, can you talk about what those items of value are?
Those items can be, in many cases, people think of it as money. It can be appreciated stock, it can be a car, it can be real estate, it can be any combination of valuable assets, including artwork, etc. And then the gifting of them is then taken as a tax deduction on your return, generally in the year that you give them. So one of the key components, and we highlighted, there is nothing that you get in return in exchange for giving that charitable contribution. So if you're going to get tickets to the Celtics or you're going to get tickets to the New York Knicks, then it's not a charitable contribution.
Great. And one of the reasons that we're talking about charitable giving today is in relation to the new Tax Cut and Jobs Act. So would you explain to us and the people here on our Facebook Live today, what does charitable giving look like? Why is it now a topic? Why do we need to rediscuss it under the new tax reform? How have things changed?
No, that's a good question, and there's a lot of things going on with the new Tax Act. One of them is the brackets have changed. So as we look at the brackets, you're not going to be able to read this, but you know, the tax brackets have changed, but what's most important is that the tax brackets grow slower. So when we look at this chart, you don't reach the maximum tax bracket until you're $650,000. So we have opportunities where before you may have been in the maximum tax bracket, now you may be in lower tax brackets. That's A. B, they've changed the itemized deductions. One, everyone knows what SALT now stands for. It is not a condiment. It is the lack of being able to deduct the total of your property taxes and income taxes. And for those of us in some of the tax states, which are here in New York, New Jersey, and Connecticut, not being able to take your deduction for state income tax is very painful. So a combination of property tax and your state income tax now maximizes at $10,000. 2 or 3. Itemized 2% below the bar, below the 2%, are all gone. Limited on mortgage. Okay, what really happened is they did increase the maximum that you can deduct for charity, but most people aren't hitting that number anyway. So what I would like to do in illustrating bunching is to actually give an example of a client, okay? So we can talk, say, Dr. Joe and Dr. Jane, and you know, one of them was an oncologist. You don't want me to do this?
No, I do. Just one quick thing before we go into that example. So The SALT was the state and local
taxes.
Local taxes.
SALT.
Okay,
State and
exactly.
local taxes.
Just before we
it
get
doesn't
into
go
the
with pepper
situation.
anymore at all.
Okay, great. Okay, so now you're going to talk to us under the new, because of the standard deduction is different under the new tax code. You're going to explain to us right now the process of bunching, which you started to talk about when I interrupted, of course, and you're going to give us
you get me on a roll and you
illustration.
interrupt you, I fall right flat on my face.
Okay, so let's talk about doctors Jane and John Smith under the new tax
code.
And
it could be anyone, but let's just take as an example that you now have property taxes of $20,000 and you pay $20,000 in state income tax. You don't have any mortgage, but you want to make charitable contributions of $15,000. Well, in 2017, you were able to deduct off of your income tax $55,000. In 2018, this is $10,000. This is still 15, but now your deduction is only 25. Now, one of the other things that the IRS did is they increased the standard deduction for a family from $12,000 to $24,000. So I'm going to do a very quick example, and let's say that you don't make a charitable contribution at all. You still get to have a $24,000 standard deduction. Concept? Well, that makes a lot of sense. I like that. So, what do I not give charitable contributions? No, we think you should bunch them. One, you're already charity minded. You're willing to give $15,000 per year. Watch this. One, we know we're only going to get, in 2018, we're only going to get $10,000 in SALT deductions. Zero pepper. $10,000. What if I did $45,000 this year, put it in a little bucket, and took the deduction this year? I still get this year a $55,000 deduction. In 2019, the 45 is sitting here. I take out the 15 that I want to make in 2019. Everyone understand that concept? I don't have any charitable contribution. I would still have this 10. Well, itemizing doesn't make any sense. So I get the $24,000 standard deduction, which I can take for 3 years because I put $45,000 away in one lump sum. So the bunching strategy is taking advantage of the new tax law to get you maximum deductions over a period of years. Does that make sense?
That makes sense. I have a concern from the other side. Let's say that I am the church that, in your case, or the synagogue that doctors Jane and John Smith. And so if you're telling me that Jane and John Smith now are making their charitable contributions in one bunching, then how does that affect the recipient of those gifts then?
That's very common that people like to make gifts every year. So I'm going to use Dr. Joe and Dr. Jane as an example. And what we did, in their case, we used a trust. I'm going to give you an example where you use something that is very simple, no legal involvement. You do donor advised fund, DAF. DAF. There's a number of them out there, Fidelity and Vanguard and the Jewish Communal Fund and any number of funds. You make a contribution, one lump sum, they hold the money. They invest the money based on your direction. Then what they do is make out checks to the charities that you tell them you want them to make them out to. So next year when you want to make to the synagogue, to the church, or whatever the case may be, you say, send off this amount of money, and they will send it off to the charitable recipient. The key is it can only go to charitable recipients. It cannot go to your personal foundation or to your personal trust. Second, you can do a trust. and become a little bit more complex, yet much more flexible.
Okay.
Do you want me to talk about that?
Yeah, if you want to talk about that, and then we'll wrap up with the qualified charitable deduction.
That sounds great. So the really important thing is I kind of drew a bucket over here, right? And we said, okay, you put the $45,000 in there. That can be any number if we create a trust. And we can create two types of trust. One is a lead trust, which means there's some type of payments going out every single year. There's a remainder trust, which says at the end of the line, the charity gets it. So a charitable lead trust says the charity gets the money each year, or a charity or a different charity gets it every year. A remainder trust says at the end of the line, the charity gets it. Now let's take all of these concepts, twist them all together, and we can create a trust that does something a little bit different. We can create a trust that makes an annual payment to the charity, and then the remainder goes to my family. If there's more in it, then I have to pay out. So if I put $100,000 into my trust, I have to pay out at least 5% per year to charity. So I pay the $5,000. If I invest that money inside the trust and it makes 10% at the end of the lifetime of that trust, I have more money to leave to my family than I started with, and I got a big bunched charitable deduction.
And that's a discussion really that you're having with your wealth advisor before you're even sitting down with an attorney to help.
Oh my goodness, yes,
exactly.
that's a great question, because one, the most important thing in all of this, because we're talking about the tax, and you have to be careful that the tail doesn't wag the dog. So this is the tax tail. It's okay? It's a very small part of the big picture. And we don't want the tax tail wagging the dog. What we want is, what is the objective for the family? How much is the charitable objective? Where do you want your money to go at the end? And you're sitting with your advisor, and your advisor saying, okay, in order to accomplish this, make it the most tax efficient, get the most money for the family, and take care of your charitable wishes, then you design it in a fashion.
Qualified charitable deduction for
retirees.
For retirees, and specifically people in a certain age bracket,
right,
over 70 and a half.
So the QCD is something that Congress made permanent, and what that is if you're over age 70.5, over 70 and a half, you are required from any of your qualified accounts, IRAs, 401ks, etc., to make required minimum distributions, which are taxable. Under the new law, you can contribute from one or many of those investments or those pools of money. You can make a contribution directly to a charity, not have it show up on your tax return as taxable income so that you don't have to do it as an itemized deduction, and it goes directly to the charity. Each individual can do up to $100,000 per year, so they could do a portion, or in some cases, all of their required minimum distribution. It must go directly to a charity, it must not go to a donor-advised fund, and it can't go to your personal trust.
And I think one of the key items or takeaways from that, as you explained it to me a little bit earlier, is if that retiree finds themselves in a different tax bracket now than they did when they contributed the monies to their, or the contributions to their retirement account. You want to just talk a little bit about that, and then we'll wrap up?
It's really interesting, because if you're in the maximum tax bracket, or you're in even maybe in a slightly less than the maximum tax bracket today, but when you contributed your IRA, you got a tax deduction at 40% or some bigger number, and now you're living in a non-tax state. You're not worried about not having state taxes. You are getting the effect of never having paid tax on that money that you're giving to the charity. So it was literally 100% deductible, which it may not be deductible if you're only in the 25% tax bracket. And we have clients that we just did a calculation for that as nice as this sounded for them, there wasn't any real benefit. They're only in the 20% tax bracket. So why do we're not avoiding anything if we do it and we structure it this way through the donor advised fund or through a trust. And so every situation is different. This was a doctor who made a lot of money, has a lot of money, but is in a very low tax bracket because we have his investments structured in such a way that it doesn't pay high taxes.
So if anyone has a question about charitable giving, what's the best way to get in contact with you?
Don't call me on my cell phone. You can call Lynette at our offices. When you call into our offices, you're always going to get Lynette on the phone, 201-447-9500, or put a request in directly on our website, www.bwmllc.com, which is probably even quicker, is to put it right into our website.
Okay, so thanks everybody. Mark, thank you so much for these strategies with charitable giving under the new tax code, and thanks everybody for tuning in. We'll see you next month.